cuts, and the story essentially being, because quite clearly it's not the same story, the story essentially being that for market participants, you price in the potential of a tax cut. You don't price in when the bill comes. And I wonder if this is the story right now. The vaccinations have started, but as always in markets, Brian, it's the journey. It's not the destination. It's better to travel than arrive as a market participant. Brian, do you think that holds true for vaccinations?
Yeah, because the market has been, the equity markets and the credit markets at least, have been responding incrementally to piecemeal good news on the vaccine all year. And there's not going to be a moment where we all kind of look around and say, everybody's vaccinated. It's going to be, like you said, this sort of journey as we go. But what we should be seeing is easing restrictions on the economic activity in the United States, and more importantly, less consumer fear of the virus. That's really the big deal. The airplanes are in the air, hotels are open, but people aren't using them to the extent they were before. So one area where I'd maybe slightly disagree with your previous guest who said that they didn't think there was going to be a big sort of boost in demand, I think there is going to be. I think there'll be a shift from goods to services, but I think on the whole, you look at U.S. household balance sheets, I mean, just really actually developed market balance sheets, high savings rates, rising incomes, propensity to spend, relatively high degree of confidence given how close we are to the end of the recession. Things are looking really good. If we could open right now, I think we'd take off like a rocket. The question is going to be how much damage do we sustain and how long is that journey going to be before we get to that, what we think is going to be a nice little boomlet in demand, maybe in the third quarter of next year.
So you're looking for Q3, Brian, just to be clear, Q3 21. That's the test. That's the line in the sand for you.
I'd love to say Q2. I think Q2 is going to be better than Q1. But if we're looking for a quarter next year where we get annualized GDP growth 7-8%, I'd be more likely to say Q3 than Q2.
Do you think we can keep pushing it back, Brian? The reason I bring this up is because this rally really started picking up in April, May. There was the talk of the summer and getting back to normal. The summer became fall became early 21, and now we're talking Q3 21. Is that too late?
I think it's going to depend on earnings. I think it'll depend on one thing we should see, I think, more before we see a huge boost in demand. We should be seeing people getting, brought back to work. We had millions of people drop out of the labor force. If we can get schools reopened or even let out for the summer, there should be more people who are able to, get back into the labor force, and that should, on its own, provide a bit of a boost to GDP growth. But I think what we ultimately should see is earnings coming through. They've been better than expected as we gone through the quarters this year. Next year, we're looking for an above consensus number 2. So that should be supportive of at least equity and credit markets next year. We also think we're getting a bit of a rise in interest rates, but nothing that's going to shatter the market's confidence.